You shouldn't have to give up your first home if you don't want to when looking to buy your next home. Whether it's sentimental value or financial gain, there are 4 key criteria you should look at before deciding to keep or sell your home to fund your next property purchase. Having a disciplined framework when making your next purchase could be the difference between buying a home you simply can't afford or letting go of an attractive investment property that you should have kept. So the question is then, how do you make the right decision? Let's jump in to criteria number 1, and that's having a sufficient deposit. Do you have the savings today to make your next home purchase work, or do you need to sell your home so you have enough of a deposit? Let's take a look at this through an example. Say your home is worth $1 million today with a $500,000 loan against it, and your goal is to upgrade into a $1.8 million new family home. With your current home, there are 3 ways to look at this property in terms of helping you with your deposit. First, there is $500,000 in unrealized equity in the property. We say unrealized because the equity is only on paper. You cannot tap into it unless you undertake a cash out or sell the property. Secondly, there is $300,000 in accessible equity. This is if you choose to borrow against the property and conduct a cash out to bring the loan to an 80% loan to value ratio. Thirdly, there is $475,000 in net proceeds of sale if you choose to sell your property on the open market. So why only $475,000 and not $500,000? This is because we assume that you will incur agent fees, marketing expenses, and legal costs to prepare your property for sale, totaling around 2.5% of the property value. Now, let's look at what it takes to buy that $1.8 million home. If we assume stamp duty, legal costs, and other setup fees come to around $90,000, a $1.8 million property actually costs you $1.89 million once transaction costs are added. If you're borrowing at an 80% LVR or a $1.44 million loan, this means that your contribution is roughly $450,000 to purchase a $1.8 million property, calculated as $1.89 million minus $1.44 million, which equals the $450,000. So you can see in this example, if you have $150,000 in savings or more and can access another $300,000 in equity from your current home, you will have enough to make up that $450,000 deposit. However, anything less than this, you may need to sell your current home to have sufficient funds. Okay, next is criteria number 2, your ability to afford the loan repayments. Let's assume from the previous example, you did access an additional $300,000 in equity. When considering the original loan of $500,000, this now takes the total loan on your existing home to $800,000. You also intend to apply for a new loan of $1.44 million to purchase your next home, taking your total debt to $2.24 million. Based on these amounts, assuming a 5% interest rate and a 30-year term with principal and interest repayments, you would be paying $4,295 per month on the $800,000 loan, $7,730 per month on the $1.44 million loan, which would total $12,025. Now, it's important to remember the total repayments are not the income per month you need, but the amount you will need to afford based on your net income, which is your income after all taxes, living expenses, and any other loan commitments are paid. Also, while this is the amount you will actually pay, interest rates can rise and banks will test you on a higher rate called the assessment rate, which is roughly 2 to 3% higher than the going rate that you'll pay. So assuming an assessment rate of 8%, you'll need to convince the bank that you can actually afford loan repayments of $16,436 per month based on your net income. The third consideration are your investment goals, whether short, medium, or long term. Conventional wisdom is that property is a long-term investment, so holding onto your current home may be part of a broader plan to have a portfolio of properties that help you to generate income in your retirement. Assuming your deposit and loan affordability is checked off, another way to think about this question is to ask what the opportunity cost of holding the property is. In other words, can you earn a higher rate of return by selling the property and investing the money somewhere else? For example, depending on market cycles, holding a property may be more attractive than putting your money in the bank. However, it may not be as attractive as buying shares in a bull market or even investing in your own business. You also need to remember that this may be driven by the condition and characteristics of the property itself. A well-chosen first home in a growth area that is easy to rent out and easy to maintain could make an excellent investment property. On the other hand, if you already live in a house and are upgrading to a bigger one, then you may think the rental yield is too low or the cost of maintenance too high to justify holding the property long term. You also need to keep in mind that keeping your home will help you avoid the transaction costs of selling and buying a new investment property that may have generated the same investment return anyway. And finally, the fourth and last criteria is your risk appetite. This consideration is about your personal comfort level around debt. So even if you can afford the loan repayments shown before, you may not be comfortable with knowing you have to make those repayments each month. Your risk appetite can change and is often a function of your personal outlook and your market outlook. For example, in terms of your personal outlook, receiving a promotion or knowing you are doing really well in your job or business may make you feel more comfortable with taking on additional debt. But if you are planning to have a family and your household income will be reduced to 1, it may make you less comfortable with taking on higher levels of borrowing. In terms of market outlook, higher interest rates may make you more risk averse, while the knowledge of a rising property market in a specific area may make you less risk averse. So as you can see, this last criteria is very personal for each individual to evaluate given their own unique circumstances and views on the market. So to summarize, when thinking about keeping or selling your existing home, we can see that the 4 reasons to keep the property are that 1, you have a sufficient deposit without selling. 2, you can afford the actual and sensitized loan repayments. 3, keeping the property meets your investment goals of building a property portfolio and earning a satisfactory rate of return. And 4, you are comfortable with the extra debt and you have a positive outlook on the future. The reasons to sell are the opposite of this, and you can see from this table that criteria number 1 and 2 relate to your financial capacity, while criteria 3 and 4 relate to your personal goals and expectations. Hopefully, this video has helped you decide whether you should keep or sell your property when searching for your next home. If you enjoyed this video, please share and follow SF Capital on YouTube and social media. See you in the next episode of how to buy your next home.